The stock market, a place of dizzying highs and gut-wrenching lows, where fortunes are made and lost in the blink of an eye. Imagine a casino filled with people from all walks of life, each placing bets on their financial futures. The air crackles with anticipation, a mixture of fear and greed. This is the reality of the stock market, a place where prices can soar to unimaginable heights, driven by speculation and hype. But what goes up must come down. Gravity always wins. These dramatic rises and falls are what we call market bubbles and crashes. So buckle up and prepare for a wild ride as we delve into the thrilling and often terrifying world of stock market bubbles and crashes. The late 1990s witnessed the rise of a technological revolution. The internet, once a niche technology, was rapidly becoming a household staple. Investors, fueled by the promise of unimaginable riches, poured money into anything remotely related to the internet. Companies with little to no revenue and even less of a business plan saw their valuations skyrocket. The mere presence of a .com at the end of a company's name was enough to send its stock price soaring. This speculative frenzy reached its peak in the early 2000s. Then, reality hit. The bubble burst. Companies that once boasted billion-dollar valuations vanished overnight. The .com crash served as a harsh reminder that even in the midst of a technological revolution, fundamentals still matter. To truly grasp the dynamics of market bubbles, we must delve into the psychology of investors. Why do otherwise rational individuals get swept up in speculative manias? The answer lies in a potent cocktail of greed, fear of missing out, FOMO, and herd mentality. Greed takes over, pushing investors to make riskier and riskier bets. The fear of missing out on potentially life-changing profits further fuels this frenzy. As more investors pile into the market, prices continue to rise, further reinforcing the belief that the good times will never end. This cycle of greed, fear, and herd behavior can continue for months, even years before the bubble inevitably bursts. The .com bubble is just one example in a long and painful history of market crashes. The 1929 Wall Street crash, which marked the beginning of the Great Depression, stands as a stark reminder of the devastating consequences of unchecked speculation. Similarly, the 2008 financial crisis, triggered by a collapse in the housing market, showed how interconnected the global economy has become. Whether it's stocks, real estate, or tulips, when asset prices become disconnected from their intrinsic value, a correction is inevitable. Learning from the mistakes of the past is crucial for navigating the treacherous waters of the stock market. The stock market, with its inherent volatility, is not for the faint of heart. However, this doesn't mean we should shy away from investing altogether. Instead, we must learn to ride the roller coaster, bracing ourselves for the inevitable ups and downs. The key lies in understanding the cyclical nature of markets. Bubbles will form and crashes will occur. The goal is not to predict these events with pinpoint accuracy, but rather to be prepared for them. This means investing for the long term, diversifying your portfolio, and avoiding the temptation to chase short-term gains. Remember, the stock market can be a powerful tool for wealth creation, but only if approached with caution, discipline, and a healthy dose of skepticism.